Welcome. You're about to listen to a simplified summary of The Psychology of Money, the insightful personal finance book by Morgan Housel. This video has been designed for English learners with a B2 level. The language is clear, the pace is steady, and the ideas are explained in a simple and engaging way, perfect for an easy-to-follow and thought-provoking experience. The Psychology of Money challenges traditional ideas about wealth, success, and financial decisions. Through compelling stories and practical lessons, Housel shows how your behavior, emotions, and mindset shape your financial journey more than complex strategies or technical knowledge. From the power of compounding to the importance of freedom, this book reveals how to build lasting wealth. Let's dive into the key ideas and powerful insights from this best-selling book. Introduction: The Greatest Show on Earth. Housel begins by explaining that managing money is not just about math or intelligence, it's about behavior. He shares his experience as a valet at a luxury hotel where he met a wealthy tech executive who was brilliant but made reckless financial decisions, and a janitor named Ronald Reed who quietly amassed millions through frugality and consistent investing. These stories highlight a key theme. Financial success depends more on how you behave than how smart you are. The book's 20 lessons explore why people make certain financial choices and how understanding psychology can lead to better decisions. Chapter 1: No One's Crazy. Housel argues that everyone's financial decisions make sense to them based on their unique experiences, even if they seem irrational to others. Your personal history with money, whether you grew up in a recession, experienced inflation, or lived through a stock market boom, shapes how you view the world. For example, someone born in the 1970s saw the stock market grow tenfold in their youth, while someone born in the 1950s lived through high inflation. These experiences create different financial mindsets. Housel emphasizes that no one is crazy for making choices that seem illogical to others. For instance, low-income households spend heavily on lottery tickets because, for them, it's a rational way to dream of escaping poverty. Understanding that people's financial decisions are rooted in their unique perspectives helps us avoid judging others and recognize our own biases. Chapter 2: Luck and Risk. Luck and risk are two sides of the same coin, and both play a massive role in financial outcomes. Housel tells the story of Bill Gates, who was lucky to attend a rare high school with a computer in 1968, giving him a head start in programming. However, he also mentions Kent Evans, a talented friend of Gates who died in an accident before he could achieve similar success. This shows how luck can make or break outcomes, even for equally skilled people. On the risk side, Housel warns that focusing only on effort or decisions ignores the role of chance. For every success story like Gates, there are countless others who fail due to bad luck. Recognizing this helps us stay humble when successful and forgiving when things go wrong. Instead of copying someone else's success, Housel suggests focusing on strategies that minimize the impact of bad luck, like saving consistently and avoiding big risks. Chapter 3: Never Enough. This chapter explores why even extremely wealthy people sometimes make disastrous financial choices. Housel shares stories of Rajat Gupta, a former CEO who risked everything for more money through insider trading, and Bernard Madoff, who ran a massive Ponzi scheme despite his success. Both had more than enough, but were driven by a desire for more. Housel explains that the pursuit of enough is tricky because people often compare themselves to others. A millionaire might feel poor next to a billionaire, just as a baseball player earning $1 million feels broke compared to one earning $36 million. The key lesson is to define enough for yourself and avoid chasing more at the cost of what you already have. Contentment, not endless ambition, protects your wealth. Chapter 4. Confounding Compounding. Compounding is the process where small, consistent gains grow exponentially over time. Housel uses Warren Buffett as an example. Buffett's $84.5 billion fortune is largely due to starting early and investing consistently for decades. Remarkably, $81.5 billion of his wealth came after age 65, showing the power of time in compounding. Housel compares this to ice ages, where small changes in Earth's orbit gradually led to massive climate shifts. The lesson is that small, steady actions, like saving a little each month, can lead to enormous results if given enough time. However, our brains struggle to grasp this because exponential growth feels counterintuitive. The key is to start early and stay patient. Chapter 5. Getting Wealthy versus Staying Wealthy. Getting rich and staying rich require different skills. Housel tells the stories of Jesse Livermore and Abraham Germansky, two investors who made fortunes but lost everything due to reckless decisions. Getting wealthy often involves taking risks, but staying wealthy requires frugality and caution. Housel highlights that survival is the key to long-term wealth. You need to avoid catastrophic losses to let compounding work its magic. This means living below your means, keeping a margin of safety, like extra savings, and not relying on past success to continue. As investor Nassim Taleb says, having an edge is useless if you can't survive setbacks. Chapter 6. Tails, You Win. In investing, a few big successes often drive most of your returns, even if you're wrong half the time. Housel explains this through tail events, where a small number of outcomes have a massive impact. For example, Disney's early cartoons lost money, but Snow White generated huge profits that transformed the company. Similarly, venture capital funds often lose money on most startups, but make fortunes on a few hits like Google or Amazon. This applies to individual investors too. You don't need to be right all the time. Just avoid big mistakes and stay in the game long enough for the big wins to matter. Housel suggests focusing on consistency and accepting that failure is part of the process. Chapter 7. Freedom. The ultimate reward of wealth is control over your time. Housel argues that being able to do what you want, when you want, with whom you want, is the highest dividend money can pay. Studies show that people with control over their lives are happier than those with more money but less freedom. Housel shares his own story of wanting to be an investment banker but realizing that the long hours would rob him of freedom. Instead, he valued flexibility over wealth. This lesson applies to everyone. Saving money gives you options, like changing careers or retiring early, which are more valuable than luxury goods. Chapter 8. Man in the Car Paradox. People often buy expensive things, like fancy cars, to impress others, but Housel points out that no one is as impressed as the buyer. As a valet, he noticed guests driving Ferraris to gain admiration, but he only cared about the cars, not the drivers. This man in the car paradox shows that possessions don't earn respect. Instead, Housel suggests focusing on humility and kindness. These traits bring genuine admiration, while flashy purchases often just make others jealous or indifferent. True wealth lies in not needing to show off. Chapter 9. Wealth is what you don't see. Wealth is the money you don't spend, not the things you buy. Housel explains that we judge wealth by what we see: big houses, nice cars, but real wealth is hidden in bank accounts and investments. Spending to look rich often leaves you with less money. He contrasts being rich, having visible wealth, with being wealthy, having unspent money. The wealthy person saves and invests, creating a gap between what they could spend and what they do. This discipline builds lasting wealth, even if it's invisible to others. Chapter 10. Save money. Saving is the most controllable factor in building wealth. Housel argues that you don't need a specific reason to save, just do it. Savings give you flexibility to handle unexpected events, change careers, or retire early. Unlike investment returns, which depend on luck and market conditions, saving is entirely in your control. Housel compares saving to energy efficiency during the 1970s oil crisis. Just as better cars and homes reduced oil use, lower expenses stretch your money further. The key is to keep your lifestyle modest, even as your income grows, to maintain a high savings rate. Chapter 11. Reasonable greater than rational. Housel advises being reasonable rather than rational with money. Rational decisions aim for maximum efficiency, like investing all your money in one stock to diversify risk. But reasonable decisions consider emotions, like avoiding investments that keep you awake at night. He shares the story of Harry Markowitz, a Nobel Prize-winning economist who split his investments 50-50 between stocks and bonds to minimize regret, not to maximize returns. Being reasonable means making choices you can stick with, even if they're not mathematically perfect. Chapter 12. Surprise. The world is full of surprises, and history doesn't predict the future as well as we think. Housel explains that unprecedented events, like the Great Depression or the rise of the Internet, shape the world more than predictable trends. Investors who expect the future to mirror the past often fail because the world evolves in unexpected ways. For example, no one predicted the Wright brothers' airplane would transform travel, or that venture capital would barely exist 25 years ago. The lesson is to stay flexible and expect the unexpected when planning your finances. Chapter 13. Room for error. Every financial plan needs a margin of safety to handle surprises. Housel compares smart investors to blackjack players who bet conservatively to avoid ruin. A margin of safety means saving more than you need, keeping some cash, and avoiding high debt. This buffer protects you from unexpected losses, like a market crash or job loss. It also lets you stay invested during tough times, increasing your chances of benefiting from rare, high-return opportunities. Housel emphasizes that planning for things to go wrong is smarter than assuming everything will go right. Chapter 14. You'll change. Long-term financial planning is hard because people's goals and desires change over time. Housel shares the story of a friend who worked tirelessly to become a lawyer but later hated the long hours. Young people might prioritize money, but as they age, They often value time with family or flexibility more. To avoid regret, Housel suggests aiming for balance, moderate savings, moderate work hours, and moderate goals. This flexibility allows you to adapt as your priorities shift, reducing the risk of being stuck in a life you no longer want. Chapter 15. Nothing's free. Everything in finance has a price, often in the form of volatility, fear, or uncertainty. Housel explains that stock market returns come with the cost of enduring crashes and doubt. Trying to avoid this price by timing the market or chasing quick gains usually backfires. He uses the example of the stock market's strong returns from 2009 to 2019, which came with frequent dips that tested investors' nerves. Accepting volatility as the cost of growth helps you stay invested and avoid the temptation to steal returns without paying the price. Chapter 16. You and Me. Housel warns against copying others' financial strategies because everyone plays a different game. During the dot-com bubble, short-term traders drove stock prices up, convincing long-term investors to join in. But when the bubble burst, long-term investors suffered because they followed a strategy misaligned with their goals. The lesson is to know your own game, whether you're investing for decades or saving for a house, and ignore those playing a different one. Housel sticks to low-cost index funds because they match his long-term, low-risk approach, not because they're the best for everyone. Chapter 17. The Seduction of Pessimism. Pessimism is more appealing than optimism because it sounds realistic and urgent. Housel notes that dire predictions like economic collapse or resource shortages grab attention, while optimistic forecasts seem naive. Yet history shows that optimism usually wins because people adapt and innovate. For example, in 2008, experts predicted oil shortages, but new technologies like fracking increased supply. Pessimism can scare you into bad decisions, like selling stocks during a crash. Housel advises balancing realism with optimism to stay invested in long-term growth. Chapter 18. When You'll Believe Anything. Stories are more powerful than facts in finance because they fill gaps in our understanding. During the 2008 financial crisis, the economy didn't change much fundamentally, but the story shifted from housing is safe to housing is risky, causing a market crash. People believe stories that align with their desires, especially when stakes are high. Housel warns that the more you want something to be true, the more likely you are to believe exaggerated stories. To avoid this, focus on facts, question narratives, and accept that the world is unpredictable. Chapter 19. All Together Now. This chapter summarizes the book's key lessons. Housel compares financial advisors to doctors. Both provide universal truths, but individuals must apply them based on their own needs. Key takeaways include: behavior matters more than intelligence. Financial success depends on discipline, not just knowledge. Luck and risk are real. Stay humble in success and forgiving in failure. Define enough. Avoid chasing more at the cost of what you have. Embrace compounding. Small, consistent actions over time yield big results. Prioritize freedom. Control over your time is the ultimate goal. Save consistently. It's the one thing you can control. Be reasonable, not rational. Choose strategies you can stick with emotionally. Expect surprises. Build a margin of safety to handle the unexpected. Know your game. Don't copy others with different goals. Accept volatility. It's the price of long-term returns. Chapter 20. Confessions. Housel shares his own financial philosophy, emphasizing independence over wealth. He and his wife live frugally, keeping their lifestyle modest despite income growth. This allows a high savings rate, which they invest in low-cost index funds for long-term growth. Housel values cash for flexibility and avoids active stock picking, believing that consistent passive investing suits his goal of financial independence. He acknowledges that his approach isn't for everyone. The key is to find a strategy that aligns with your goals and lets you sleep at night. Independence, not riches, is his ultimate aim. Postscript. A brief history of why the U.S. consumer thinks the way they do. Housel traces the evolution of U.S. consumer behavior since World War II. After the war, economic growth, cheap credit, and pent-up demand fueled a spending boom. The 1950s and 1960s saw rising incomes and a narrowing wealth gap, creating a sense of shared prosperity. However, from the 1970s onward, growth became uneven, with stagnant wages for many and rising inequality. Despite flat incomes, Americans kept spending, driven by easy credit and cultural acceptance of debt. Homes and cars grew larger, and debt levels soared. The 2008 financial crisis reduced debt temporarily, but low interest rates and social media's comparison culture kept spending high. Housel concludes that today's consumer mindset, focused on keeping up with others, stems from decades of debt-fueled growth and social pressures. Conclusion. The psychology of money teaches that financial success is less about formulas and more about understanding your behavior, emotions, and goals. Through engaging stories and practical lessons, Housel shows that wealth comes from discipline, patience, and aligning your money with what matters to you. Whether it's saving consistently, embracing volatility, or prioritizing freedom, the book offers timeless advice for anyone seeking financial peace. By focusing on what you can control, saving, staying humble, and planning for surprises, you can build wealth that lasts. Housel's message is clear. No one is crazy, and everyone can find a path to financial success by understanding the psychology of money. That's a wrap on our summary of The Psychology of Money by Morgan Housel. We hope you enjoyed these powerful insights and feel inspired to take control of your financial journey. If you found this video helpful, please give it a thumbs up and share it with someone who could use these lessons. Don't forget to subscribe and hit the bell icon so you never miss a new book summary. We'd love to hear from you in the comments. Tell us which book you'd like us to summarize next. Your suggestions keep this channel growing. Thanks for watching, and we'll see you in the next video.